Yeah, now we'll continue with a few more strategies where we have stopped the last session. We have primarily looked at the spread based strategies apart from the basic strategies of covered call and protective put. So, when we come to the combination strategies, the focus is primarily on one call and one put. Whereas in all the spread strategies, it is the same instrument, whether it is call or put, but you do one buy on it, one sell on it. Whereas when we talk about combination strategies, it's a combination of both a call and a put. Either I go long on both of them or I go short on both of them, right? Again, it could be both of them with the same strike price, both of them with the different strike price. All these are the possibilities that can come up. And that is where the names come up, which are straddle. So when we say straddle, we are buying one call, buying one put. So how does it work out? Let's say if we have to continue the same example which we have looked at for the other things. Okay, in this same example, let's say we had 2950 put at 37.6, right? So let me, if I look at the data now, the numbers would be different. So that's where I'm taking. So when I take a straddle, all I am saying is 12950 put plus 12950 call, which means I'm actually buying a call as well as a put, both of them having the same strike price. So because I'm buying both of them, I'll have to pay premiums for both of them, right? So what is the 2950? Yeah, 2950 call I think is available at 109.1 on that day, right? 2950 call is available at 109.1 and 2950 put is at 37.6. Okay, 2950 call is 109.1, whereas put is 37.6. So if I am buying these two, right, obviously if I create a similar kind of a strategy, what comes out to us, if I'm creating a similar kind of a strategy, what is coming out to us is, okay, premium is an expense. Whatever is the case, the premium is an expense. So probably the expense is to the extent of this, the summation of these two. So this much is the loss directly because of the premiums. Now because I am long on both of them, right, because I am long on both of them, I'll find out what is the payoff on long call. Similarly, what is the payoff on long put? From there, I'll find out the total. So, buying a call, if the market price goes to 2800, right, I will not exercise the call option, because I'll exercise the call option only if the market price goes above 2950. So, until that time, I will not exercise the call. So, here I'll start exercising the call, and because of the exercise of the call, probably I will get a profit of 50, 100, something like this, correct? So these are the profits that I am going to get in this strategy. Same way for the put, because I have purchased a 2950 put, as per a put I will exercise it if the market price is less than the strike price, right? So anything above the 2950 I will not exercise it at all. And in this case, probably I'm getting a profit of 50. Here it is 100. Here it is 150. So from this, I can find out my total profit. So my total profit is working out to the summation of these three. So my total profit is something coming like this. So probably if I start plotting a graph, what I observe is a kind of a V shape. Kind of a V shape is what we observe, right? Probably if we are doing a bit more on the prices and all. So probably it is showing that if the market is highly volatile, either going in the downward direction or in the upward direction, highly volatile between probably 2800 to 3100 kind of a range, if it is there, you are making losses. But if it crosses this 3100 some mark, or probably below 2800 kind of a mark, there is going to be enormous profits, unlimited profits in both the directions. So this is like a highly volatile kind of a strategy. If you don't know in which direction the market will move, but it will move drastically. You don't know in which direction it will move, but you are sure that the move will be drastic. In those cases, you are resorting to a straddle kind of a strategy, a long straddle, because you see that the profitability is more high after a certain point. But if the prices are within a particular range, there is a negative thing that is coming up. There is a loss that is coming up. This is for a long straddle because you have both longed on both the aspects, long on call, long on put. But if you have shorted on both of them, it's exactly the inverted graph that comes up. Short on call, short on put, which would be like an inverted V. So as long as the stock is fluctuating in between a particular range, you will make a profit. But the moment it crosses a particular range, you will actually make a loss. So someone who is more, who is feeling that volatility is much lesser, and he wants to exploit on that, he will get into a short straddle strategy. But someone who thinks that the volatility is more and he wants to exploit on that, he will go for a long straddle strategy. But the only difference being, in a long straddle, the maximum loss is to the extent of sum of both the premiums. Right? So if you remember from one standpoint, you can very well address both the other things. Now, on the same lines, the next strategy, which is a strangle strategy, got built. The only difference between a straddle and strangle is, see here, you are having premiums which are very high, and that too because you are choosing the same strike price. What this says is, the strangle strategy says, go for a OTM call and OTM put. Out of money call and out of money put. Out of money call is something which has a very high strike price because its premium will be much lesser. Out of money put, something which has a very small strike price. Right? Something probably a 3,500, 3,050 call, not 2,950. Go for a 3,050 call and probably 2,850 put. Both of them will be cheaper compared to these numbers. Probably if you look at just for from this data, if I want to see a 3,050 call, you see it is available for 49.9. Suddenly my premiums will come down drastically. Right? And okay, let's assume that this is 49.9, which is a 3050 call. And because I am going for a 3050 call, even at these places I will not exercise, right? Only from here the exercise starts. 50, 100, 150. This is a 3050 call. And similarly, let's assume that we are going for a 2850 put. Just for on a virtual basis, I am saying that the premium is just around $3, because it will not be more than that, or even it would be much lesser than that also. Okay, I'll assume that the premium is $3, and even these two scenarios will not be exercised in case of a 2850 put. So here you will have a payoff of 50. Now you see here, even more wider range, even more of a wider range, your profitability is existing. So if you if you think that the volatility is going to be very, very high compared to the previous strategy, but you don't know in which direction the stock will move. See, sometimes some events will lead to this. Okay, merger. When X is acquiring Y, you know that Y will have a drastic change, or X will have a drastic change. Both of them may have the scenario. X will have a drastic change or Y will have a drastic change, but you don't know in which direction that change will come. If the merger is a success, then probably it may go high. If it is a failure, it may go low. Or the day of annual result, right? The day when the company is releasing its annual result. If the result is good, the stock price may mount up like anything. Result is bad, the stock price may fall like anything. So, but if you want to make a profit in both the scenarios, in both the markets, you can resort either to a straddle or a strangle strategy. But the only thing is, in strangle, your maximum loss is decreased drastically. In the earlier case, your maximum loss was almost 150. Whereas here your maximum loss is just somewhere around 52.9. But you will make a profit when the market moves quite drastically. But if it is fluctuating in a very narrow range, you will actually lose to the extent of 52.9. But at least that loss is capped. You don't lose significantly also. Right? These are the typical straddle strategy, and probably what we'll see is one of the this is a strangle, more like a cradle. That's the reason it has been given a strangle kind of a strategy, right? So it's more like a kind of a cradle kind of stuff where there is a flatness here, whereas in case of straddle, it's a pure V, because both of them have the same strike price. And sometimes what people resort to is a bit more bullish. See, they say that they are volatile, they are more on volatility, but in that volatility also, if they are slightly more towards bullish, what they'll do is they'll buy two calls and one put instead of one call and one put, because slightly more bullish. Slightly more bullish, they'll buy a bit on the positive side, going up, because call will get a profit when the market price goes up. So they go for two long calls and one long put. In that case, what happens, instead of a kind of symmetric kind of a picture, you will see a slightly tilted kind of a picture, a bent, where probably instead of a proper V, you will see a kind of tilted V, where the profit on the upward movement is more, but the loss on the downward side is not that higher. Whereas when you are more bearish, you will find when you take two puts and one call, you will find that again that symmetric V will get tilted a little bit, wherein you will get more profit when the price actually goes down compared to when the price going up. So these are some of the kind of strategies which people resort to. And there is one called as collar strategy, which is nothing but combination of protective put and covered call. See, if you look at the graph, You see, covered call strategy is, it will make a loss when the price is going down. The profit is fixed when the market is going up. And you look at, this is the protective put. It will make a profit when the market is going up, whereas the loss is limited. Now you combine these two, it will look like a spread strategy, right? Just overlap these two graphs, just superimpose these two graphs. It will simply look like a kind of a bullish spread kind of a strategy, right? You will find a bullish call spread or bullish put spread kind of a strategy is what you look at. So that kind of a strategy that is created using a covered call and protective put is what is called as a collar strategy. Even we'll use the word collar very heavily even in interest rate kind of options, right? But the typical definition is you are creating a spread using two different strategies altogether, right? Otherwise what you are doing, buy one call, sell one call. Through that you have created a spread strategy. But here what we are saying is, see, in case of protective put, we are going with a long put. And in case of covered call, we have gone with a short call. So with still one call and one put, it's still a combination strategy. With a combination strategy also I can create a spread. And that's the reason the collar is of a very important kind of a tool, because we are not operating in the same call market. If there is a mispricing between call and put, using the call put parity relationship, I can play on the call and put and still create a spread. Whereas if we talk about typical spread strategies, we have to focus only on either call or put. So that's the reason collar is a more important strategy. Though operating in both call and put, both the markets, I can create a kind of a spread strategy, right? Now, these are the various trading strategies that are present on options, especially stock specific or index specific or portfolio specific kind of options. These are the most common ones that are prevailing in the market. Now, the same logic can go for interest rates, right? Probably a simple scenario is, let's say I have taken a floating interest loan, right? So whatever is the interest rate in the market, I have to pay that much interest, right? 5%, 7%, 10%, whatever is the interest rate that is growing, I have to pay that much. Now, if it grows to 20%, I have to pay 20%. That is where we can come out with a kind of an option. If the interest rate crosses 10%, I'll pay only 10%. That's what is the definition of an option. If the price crosses a certain level, then only I have a benefit. I will purchase it only at that price. Here also what we are saying is, in the interest rate kind of options, the logic goes like this. Even if the interest rates cross 10%, I'll pay only 10%. I'll fix it at 10%. Whereas in case of FRA, what is the scenario? We'll fix the interest rate. Whether the rate goes up or goes down, I'll pay the same fixed rate. Whereas in case of interest rate option, that's not the case. We can very well choose. Okay, as long as the rate is below 10%, I'll pay the variable rate itself. But if it crosses 10, I'll pay a fixed. So that is where the option is coming, which is at the hands of the payer, who can decide what rate he can pay. So because the lender is giving such a kind of an option, some kind of a premium needs to be paid to the lender outright, and that premium will give a kind of a flexibility to the borrower that whenever the interest rates cross 10%, he can still pay at the rate of 10% itself. That is called as a call option on the interest rates. The specific name to the call option on the interest rate is nothing but a cap. We are putting a cap. Any interest rate above 10%, I'll still pay at the rate of 10% only. And because of that cap, if the interest rate increases, see, we all have to understand that as the interest rates are increasing, the bond prices are falling, because we have already seen the relationship between the bond prices and interest rates follow a kind of a decreasing kind of a relationship. So if the interest rates are increasing, the bond prices definitely fall. So you don't need to remember from that lines at all, right? As long as you are clear of that inverse relationship, as long as the interest rates are increasing, right? The if the interest rates in the market are increasing, the call option will have more demand. See, it's as good as saying probably the market price is increasing. If the market price is increasing, call option premium also increases. We have seen the factors that are affecting the call option price, and in that grid we said as the price increases, the call option premium also will increase. So here also, as the interest rates increases, the call option premium also increases. Call option on the interest rates, whether it is interest rate cap or whatever it is, the call option on the interest rates increases. If the call option increases, the bond value will come down, right? And similarly, there is another interest rate called floor. Floor is on the downward side, especially if you are a borrower, lender. Especially if you are a lender, you are receiving floating rate. Okay, when the market rate is 7%, you will receive 7%. 5%, you will receive 5%. 1%, you have to receive 1%. That's where probably the lender will take an option, which is like a put option, saying if the interest rate falls below 4%, you have to still pay me 4%. That 4% is what we are calling as a floor. Right? Even if the rate is 1% in the market, you have to still pay me 4%. So because I am taking such kind of an option from you, I'll pay a premium to you. Right? This logic is what we call as the bonds which follow this kind of logic we call as callable bonds, or probably the bonds which follow the put option kind of a logic, we call them as puttable bonds, where the interest rate is frozen. Right? If the interest rates cross this particular level, we can still will still pay only at this rate. And bonds which are issued following a similar kind of a logic, we are calling them as callable kind of bond, because there is a call option. Though the call option is present on the bond, but the bond is indirectly linked to the interest rates. If the interest rates are falling, now look at it like this. If the interest rates in the market are falling, the bond price will go up. And if the bond price is going up, the call option value will go up. Right? Market prices are going up, stock prices are going up, the call option premium will go up. Both of them are positively correlated. Here also, when the interest rates are falling, because of the inverse relationship between the interest rates and the bond prices will go up. The prices are going up is an indication that the call option premium will typically go up. The same logic you can infer with respect to the put option. So whenever we are saying I am taking a long cap is what fixing the interest rate on the higher side. So when you are taking a long cap, it means anything which is where the interest rate goes above a specific rate, we call it as strike rate. Just like we call it as strike price here, there we call it as strike rate. Let's say we have fixed the strike rate as 10%. Wherever the interest rate in the market crosses 10%, we are still paying at the rate of 10% only. So that interest rate, let's say we have taken a 5-year loan. We have taken a 5-year loan where the interest payments happen every 6 months, right? So, and I have taken a cap saying during this 5-year period, any time the interest rate crosses 10%, I'll pay you at the rate of 10% only, not for whole period. Let's say after 6 months, the interest rate is 8.5%. I'll pay only 8.5%. If it is 9, I'll pay only 9. If it is 11, only for that period, I'll pay 10. That is the typical pricing strategy. Now, because there are multiple payments, each separate payment, where I will see what is the chance that it will cross 10%, and what is the chance that I have to pay only 10%, which means how much is my benefit. See, if it goes to 11%, 1% is my benefit. If it goes to 15%, 5% is my benefit. So, what is the chance, first of all, that it will cross above 10? And if it crosses, to how much extent it can cross? Right? I will again use a binomial tree model, because Black-Scholes model will not work in those kind of scenarios, because Black-Scholes model assumes the interest rates are constant. Here we are varying the interest rate. So that's where binomial tree model, using the binomial tree model, we can very well predict what is the probability that there is an upward movement more than 10%, and to what extent, what is the average increase rate. So based on that, what I will decide is what should be the premium, or what is the value at each of the periods. There are 10 payment periods. So what is the chance that it crosses a particular interest rate of 10%? So each of those individual points is actually called as caplets. Is actually called as caplet, and the sum of all the caplets together is what we call as cap. Right? So because we are talking about 5-year period where 10 payments are there, and for each payment there is a different probability that the price, that the interest rate will cross 10%. And if it crosses 10%, to what extent it can grow? What would be your typical benefit? So the value of each of those periods is what is called as a caplet, and the sum of all those caplets, 10 caplets over 5-year period, is what we call as the value of the cap. So that much premium has to be paid outright in order to take this option. The same logic goes in case of the floor. Right? The same logic goes in case of a floor. Each period going below a 5%. Right? So what is the chance that it goes below 5%, and to what extent it can go? Each one is called as a floorlet. Sum of the values of each of the floorlet is what is coming out as a floor. And just like we created a simultaneous position in a call and a put, because you always look at cap as a call option, floor as a put option. Just like, probably even if you are slightly confused, if you correlate it with respect to stocks, saying cap is equivalent to a call option, floor is equivalent to a put option. Right? Using a call and a put, earlier we have created a kind of spread position using collar, which involved buying a put, selling a call, because buying a put was creating a strategy of protective put. Selling a call was creating a strategy of covered call. Using these two, buying a put and selling a call kind of a strategy, we have created a kind of spread collar. That is what we have called. Same name we can use here also. The collar strategy is nothing but, think of it, buying a put, selling a call, means buy one, sell the other. So buy a cap, sell a floor. Buy a floor, sell a cap. These two are two different kinds of collar strategies. Both of them at the same strike rate, same exercise rate. When you buy a call or sell a put, or buy a put and sell a call, both of them, they create a kind of collar position for us. Collar position is nothing but a spread position, but the typical spread position always talks about two similar kind of uh, tools like buy call, sell call. But the collar position is creating the same spread using two different tools. So if I know that the interest rates will vary between 5% to 7%, I can take an advantage of this kind of a strategy, right? So these are the similar various kinds of trading strategies that are available on the options, on the stocks, as well as on the interest rates. We have to be just comfortable with the calculations associated with them, because most of the calculations involving these things will talk about, okay, what the price on the maturity date is something. If that's the case, what is the profit in this option? Just like the way in the spreadsheet we have done, if the price goes to 28, 503, 35, 32, whatever it is, what was that overall profit? That would be a typical kind of a question which you can look at, right? You have purchased a call, two calls with this kind of, with at this premium, one put at this kind of a premium, and finally on the maturity date the stock price has gone to this. If this is the whole structure, what is the profit in the whole transaction? So these are the typical kind, or even with respect to the interest rates also. So we should be comfortable with the basic calculations associated with the interest rates and the call option premiums. Where do you look at the profit? Where do you look at the loss? That will solve all the questions from this particular chapter, right?